Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at Microsoft. I had mentioned it in the last video. I wanted to run the numbers again, see what's going on, because I do like their growth rate. It's great here. Analysts like it too, about 13% annually in revenue. But I feel like it's still a little elevated at the moment. Not as crazy as it used to be. It has been as high as almost $470 in the last 52 weeks. But I'm coming up with a fair value of 307, just kind of cash flows of 309. So I'd really like to see it 310 or below. It's currently sitting at 368, but they do have really strong returns. 13.65 based off the thesis that we come up with here. And then once you factor in that dividend, 14.5%. That's really strong, better than you would see out of the general market, that 8 to 10%. So how does that compare? Well, essentially, today's price is the price fair value 3 years out from now. If you think it's going to continue trading at a 3-year multiple, it's a great time to get in. But if you don't, you think that there's threats somewhere that they won't continue at these super strong growth rates, then you may want to wait and see what happens. And ideally, 310 would be as high as I'd really like to pay for a full share. I mean, I'm trading options, picking partial shares up here and there, nothing too crazy. But I mean, if this gets down to 275, I would be willing to buy 100 shares of this. So that'd be a almost $28,000 position at that point. After what I saw at the conference and all of the stats and growth rates that I saw, I definitely believe in their future. My employer is moving more towards them as well. Well, let's get into the numbers and see what the numbers say. Earnings yield, we're coming up with 3.8% just about. So we'd want to see earnings per share of 18.4 for what we are getting. And what we're actually seeing out of them is an expectation from analysts of 13.14 this year and 15.01 next year. So clearly the earnings are trading at a multiple of 3 to 4 years out. Cash flow yield down a little bit from the average, 30%, still super strong, but on average we've seen 31.15 over the past 5 years. Dividend yield right about the average, just a bit lower, coming in at 0.8%, on average 0.86. Off of last year's earnings, that's a 23.5 payout ratio, which means their earnings per share, you're getting paid out nearly a quarter of it. And off of this year's expectations, 21.23. So they should be able to comfortably grow that dividend. Again, for a dividend stock, we like to see that closer to 50%, 30 to 50 is ideal. They are a little low, but they aren't solely focused on dividend. ROE looks super strong, 33%. That's not too diluted. Debt to equity is below 1, where we like to see it at 0.91. So that's good. ROI 18.17. So their investments are paying off. And ROA, assets are paying off as well, 17.2. This is great. This is great. This is where I have a little bit of pause. I just think that the market has a bit too much baked into it, but that's because it's such a great stock. So off of a dip like we're experiencing, this is where you might get the chance to get into it at a super solid price. Gross margin, 69.8, on average 69. So they're just shy of 70, up a little bit over their average this last year. And then for the net, just shy of 36, up a little bit over their average as well of 35.8. So the PE ratio currently is about 28, which for them isn't insane. I mean, we see them come in typically around 27 over these past few years, and their earnings growth rate is 14.23%. So that gives us a price to earnings growth of almost 2. So based on the earnings growth, we're expecting it is kind of overvalued. Now we can get into this thesis where this is coming from. So analysts are mostly dictating this revenue. I mean, over the past 3 years, we've saw 13% compound annual growth. Analyst projections of just shy of 13% this next year, and then 13.26 the following year. So 13 seems to be a very fair number for the revenue growth for this company. Share count, I mean, maybe a quarter is a little high. I'm expecting with this pullback, if they continue their share buying, I mean, you can see there's $100 difference. So they could buy 1/5 more shares than they did last year if they were buying at those elevated prices. So I'd expect to see it a bit higher than what we saw over the last 2 years because price is lower and there's less shares that exist. But over the last 3 years, it's 0.42. So it depends on their budget. And if there's another federal change where they're able to get tax benefits off of buying back shares or bring back money from overseas, there's a lot of factors. And that's why we see a lot of share buybacks across the market, is because during the last Trump administration, they allowed money to come back and they gave beneficial treatment to share buyback. Assets, I mean, 13 might be a little high. They came in at 12 over the last 2 years. Maybe we go a little bit lower with their balance sheet growing. Liabilities tend to be between 7 and 8, so 7.5 seems fair. Dividend, I'd expect a pretty strong dividend growth out of them. I mean, if they do come in at this 6% they have over these last 2 years, you'd be looking at in 5 years being about $4 per share, which means buying at today's price, you're looking at a yield on cost of 1.1%. So definitely not a dividend stock. I mean, it's one of those blue chip stocks that happens to pay a dividend. And then margins, small growth. I mean, I'd expect flat or small growth, really. That's all, unless a competitor pops up and they have to start lowering their prices to compete. But I don't see that happening anytime soon. So in the next 3 years, we'd expect the fair value to be right about $360, which is a little south of the share price at the moment. It says 0% gain because you do get dividends in the meantime. So I'd say essentially, if you're buying in this $360 range, you're buying at 3-year out prices. And then in 5 years, if they're able to sustain the growth that we've seen from them, you'd be up 15% on your position. But in the meantime, SPY is up 47%. So you'd be hoping that in 5 years, they still have the same market position that they have at the moment, where the market's willing to trade at multiples 2 to 3 years out, in which case the share price would be over 500. So financials look super strong. The COGS are really flat while the revenues are growing. That is really nice to see. The EBIT is higher than the net profit. So it looks like they're paying a lot in interest and taxes. But the gross profit, we see nice, strong growth. Everything's showing a really similar pattern here. Nothing really stands out. Balance sheet, we actually have tangible assets. Looks like they're pretty flat. I mean, there was a jump from 2022 to 2023, but 21 and 22 were kind of the same. 23 and 24 were kind of the same. So it doesn't look like massive growth in those tangible assets. But the assets as a whole are definitely just going off to the races. And there is a tangible book value here as well. So you see the debt is following a similar trend to the assets, but the assets are outpacing it enough that we have a nice balance sheet here at the company. I mean, we see 600,000 millions up here for the assets, and 250 is the mark down here. 300,000 they haven't quite hit yet. So the debt makes up less than half what the assets do. Cash flows are strong. Bit of a down year in 23. Got right back to it in 24. So we'll see if they're able to continue that. And then the dividends, they're a dividend growth stock. I mean, 6% is a pretty good growth rate, but I think that the value is always going to outpace the dividend. I don't think that there's really going to be a time where you can get into this for like a 3% yield, although I wish. And then everything. So I'll zoom in a little bit so we can look closer. And down here, the balance sheet, kind of lower than everything else. Not too crazy, pretty common. Bringing in about $100 worth of value. Cash flows are above that. You see the spacing between these? Like, they're very consistent. The balance sheet, the cash flows, and the fair value. And then everything else is kind of in flux. So you see, at no point in the last 5 years has this stock been worth its fair value. It's always been trading at a premium. So maybe knowing that fact, we look at it and say, okay, 350 is our new target. If we can get in at 350, then that would mean, since we're basically flat right now, we'd have a $17 profit per share in a 3-year time period on the fair value. The dividend was leading in 2023 and has fallen behind as of 2024. So there was quite a bit of value that was coming from that. Well, that is based on their traditional dividend yield. So if their yield 0.7%, then with that 6% raise, that is going to bump it up quite a bit. And then we have the actual share price. So I would say that the share price moves pretty well in line with earnings. So a 27 PE seems to be really what this company trades at, plus or minus maybe 3. There's not anywhere where there's a massive gap. Maybe in 2021, but that was the recovery time period, so it could explain a bit of a catch up in the share price. So that would mean right now the price is pretty fair, maybe a little elevated. 360 to 363 would really be the place to get in if you're trading strictly on the earnings. And that's what I have for this one. My interest is peaked. I do really like this growth rate. It'd be nice to get a better dividend yield, but the market just really favors the stock, and I understand why. High cash flows, high returns, low debt, strong margins. There's really nothing to complain about here aside from how expensive it is and the premium that you're buying it at. It's definitely on my list to watch. If it goes below 350, I'm buying. If it goes below 275, I am going very heavy. That is, as long as the fundamentals don't change. So I think that's all for this one. I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.